Hi, I'm PNC Joe, and I only talk about commercial insurance. Directors and officers insurance might seem distant, but it hits close to home for many small business owners. This essential coverage protects leaders from personal losses due to management decisions, yet understanding its full scope can be challenging. The complexities of legal claims and regulatory changes make navigating this topic a significant hurdle for many. Keep watching because in this video, we will discuss these important topics. What is directors and officers insurance? Why do companies need directors and officers insurance? What does D&O insurance cover? What are policy exclusions in D&O insurance? How does a claims-made policy work? What are Side A, B, and C coverage? How are defense costs handled under the policy? What factors influence the premium for D&O insurance? And a bonus topic at the end. Let's go through these points one at a time. Directors and officers insurance, often called D&O insurance, is a type of insurance that helps protect the people who make important decisions in a company. These people are usually called directors and officers. If they make a decision that causes a problem, like losing money for the company, this insurance may help them cover the costs of addressing the issue, subject to the terms and conditions of the policy. Companies need directors and officers insurance because it offers protection against legal troubles. Imagine if a director makes a decision that some people don't like and they decide to take the company to court. The insurance may help pay for the lawyers and any money the company might have to pay if they lose in court, subject to policy terms and conditions. This way, the directors and officers are not scared to make big decisions. D&O insurance covers several things. It may pay for legal defense costs, which means the cost of hiring lawyers, subject to policy terms and conditions. It also covers indemnification for settlements and judgments, meaning it may help pay if the company or its leaders are found guilty and have to pay money. Additionally, it covers employment practices liability, fiduciary liability, and securities claims. These are fancy terms that mean it helps when there are problems with hiring and firing employees, managing employee benefits, and issues with stocks and shares. Policy exclusions are situations that the insurance does not cover. For example, if a director knew something was wrong and did nothing about it, the insurance might not pay for the consequences. Understanding what is not covered is very important so that companies know when they need to be extra careful. A claims-made policy is a type of insurance where you can only make a claim if the issue happens and is reported to the insurance company while the policy is active. Imagine if you have a problem while your policy is active, but you wait until the policy ends to report it. In that case, the insurance might not cover your claim. This is different from occurrence policies that cover events happening during the policy period, even if they are reported later. Side A, B, and C cover different things in D&O insurance. Side A covers the directors and officers when the company cannot help them, like if it goes bankrupt. Side B helps the company when it pays to protect its directors and officers. Side C, also known as entity coverage, helps the company itself when it is taken to court. Defense costs are the expenses for lawyers and legal processes. In D&O insurance, these costs are usually covered by the policy, subject to the insurer's approval and policy terms. This means if someone takes the company to court, the insurance may help pay for the lawyers to defend the company and its leaders. The premium is the amount of money a company pays for insurance. Several factors influence this amount. These include the size of the company, the industry it is in, and its history of legal issues. If a company has had many legal problems before, it might have to pay a higher premium. Common exclusions in D&O policies include fraud, personal gains from illegal acts, and claims made before the policy started. This means if a director commits fraud, the insurance will not cover the consequences. Knowing these exclusions helps companies understand the boundaries of their coverage. Regulatory investigations happen when the government checks if a company is following the law. D&O insurance can help cover the costs of these investigations, subject to policy terms and conditions. This support is crucial because regulatory investigations can be long and expensive, and having insurance can ease the financial burden. I hope this deep dive into directors' and officers' insurance has provided you with a clearer understanding of its importance in protecting the leaders of your business. Navigating through the intricacies of D&O insurance can empower your decision-making and safeguard your company from potential legal hurdles. If you have any questions or ideas for future videos, please let me know in the comments below.